Hello everyone, welcome to today's webinar, Career Insights, NBFCs and Credit Fintech Platforms, hosted by CFA Institute and CFA Society India. I would like to take a moment to welcome our audience from around the world joining us remotely. I'm Litesh Gada, CFA, founder of Aureus Assets and director at CFA Society India, and I will be moderating for today's webinar. At Aureus, we provide consultancy services like business consulting, valuation, and transaction advisory services. Before I introduce our speaker for the day, I have a couple of housekeeping notes. Today's webinar is scheduled for 60 minutes, including Q&A, 45 minutes presentation, and last 15 minutes for Q&A session. We will be leaving enough time for Q&A after the presentation. Please feel free to submit your questions throughout the presentation. You can do so by clicking on the Q&A icon at the bottom of your viewer and typing your question in the box. This webinar presentation will be available to view after the presentation concludes in the chat box. We value your feedback, so please complete the evaluation survey before you sign off the day. Now, it is my pleasure to introduce our speaker for today's webinar, Ms. Bama Balakrishnan, CFA. Bama is an independent consultant and C-suite financial services leader. Bama has more than 2 decades of experience in the financial services industry with broad view of banking, non-banking financial services, impact investing, and alternate investment management. She spent more than a decade each with ICICI Bank and Northern Arc Capital, playing multiple chief executive officer roles in her latter position, in addition to serving as a member of the investment committee for funds managed by a subsidiary, that is Northern Arc Investments. Most recently, Bama was COO at Northern Arc, leading the intermediate retail and mid-market business across origination and placement. Bama, over to you.
Thanks a lot, Litesh, for the kind moderation and introduction. It's an absolute pleasure to do this webinar for the CFA Society. And I think it's an interesting and innovative idea to think about opportunities for CFA candidates, charter holders, in what's a very large and fast-growing sector in the Indian financial services space. Before I begin, I think we had a small poll that we wanted to run. If I can request the team to put that up, then I'll continue with my comments while we get the response to that. I thought before I dive into the content that I have for the day today, I'll share some glimpses of what my journey as a CFA charter holder in this sector has been. So I did my CFA charter midway through my career, you can say roughly about 10 years after I completed my PGDM from IIM Ahmedabad. And my thinking at that time was that, doing the CFA qualification and acquiring the qualification would give me skills that are particular to thinking about investment management, portfolio management, deeper analytical skills, capital allocation questions, portfolio management questions, and so on. And I think that's really what sort of changed in terms of how I approach different roles in the next stint that I had with Northern Arc. So be it the risk role where, we used analytical models to think about not just at a loan or a individual credit portfolio level, but at an aggregate portfolio level using models to think about predicting, risk patterns in the portfolio. Or as CFO thinking about how do we, allocate capital across different businesses and model the capital requirements that we had and so on. I think the approach and the thinking changed significantly thanks to, what I got as perspectives through the CFA charter. And I think that's an insight I wanted to share with all of you. Because I think the way the NBFC sector is now shaping up and the way the regulators kind of driving the thinking in this space and the way the capital markets are also evolving, we see, more and more opportunities for such roles in the NBFC space. And Litesh and I were briefly chatting before the session, and he also brought this perspective that A lot of these businesses now operate across regulatory forms. And what we mean by that is that a lot of these businesses sit within, let's say, alternate investment funds. Some of them sit within segments of banks. Some of them sit within NBFCs. And therefore, thinking about such opportunities and acquiring these skills significantly expands the set of opportunities for CFA candidates and charter holders. So I think hence the presentation and the comments should be useful context for all of you. I'm just going to wait a moment to see if we have any output from the poll that we can take a look at before I get into the slides for the session itself. Can we close the poll and show the results, please? All right, I think we have a fair sense of, what people are thinking. So I'm going to start, continue with the session, and then we'll take questions at the end. This is the broad outline that we have for the session today. So we'll start with a very quick overview of the industry landscape, especially since a lot of you are here to learn more about the NBFC space, talk about key recent trends in the industry and also the recent regulatory developments as it relates to career opportunities, generic org structure, and then we'll focus more deeply on the functions which are relevant for the kind of skills that we acquire in a CFA qualification. And talk about how opportunities in the sector may be tapped. And that's the broad approach. I think the recent RBI estimates for GDP growth rate for India are close to about 7% plus, about 7.2%. And obviously that comes from growth in both investment and consumption. And this requires significant growth in credit to support the growth of the economy. Consequently, the systemic credit in India is expected to grow between 10 to 12% over the next couple of years. NBFCs have had a fairly stable share of about 18% of overall systemic credit. And growth in NBFC credit, particularly growth in NBFC retail credit, is also expected to be about 13 to 15% over the next couple of years and reach close to about INR 23 trillion in a couple of years. The spectrum of NBFC retail credit basically covers housing finance, auto finance, microfinance, gold loans, consumer durable finance, different forms of personal loans, and MSME lending, and so on. I think if you think about the mix of the liability side, borrowing from banks still remains a fairly significant share of financing for NBFCs, over about 35%. And this remains particularly large for medium and large NBFCs. The really large ones or the better rated ones are also able to better tap capital markets as well. And we'll speak more about that as we go along. One of the interesting facts about NBFCs is also that they are very large participants in a very significant part of the capital markets in India, which is the securitization and the direct assignment market. NBFCs sell down substantial amounts of assets through these products. Interestingly, they're also a large volume in terms of investors. So while banks participate in these markets primarily based on their priority sector targets in many cases, NBFCs come in here primarily from a risk and reward perspective. If you think about the classification of the NBFC space, I think one way to think about it is the way the Reserve Bank has now tailored regulations for the sector. So the base layer is a very large number of small NBFCs. The middle layer and the upper layer becomes more relevant when we think about particularly opportunities, as the CFA charter holders or candidates, where you have meaningfully large entities of at least about 1,000 crores plus, and entities which are specifically identified by the regulator as being systemically important. And the regulations in these cases are specifically tailored to these entities as well. A brief overview of how we think about products in the NBFC space. So at a very aggregate level, you can think about the split of credit delivery between institutional and retail finance. And institutional finance, apart from real estate lending, which is a large part of the market, includes financial institutions lending, where NBFCs lend to smaller NBFCs or to housing finance companies and so on. Lending to mid-corporate entities, which could be balance sheet financing in the form of working capital or term lending, which happens. A large part of the industry is also situational financing, which includes project financing, acquisition financing, and refinancing for that. This is, I think, generally referred to as the high yield or the private credit market. And then you have the more nascent business of venture debt, which is, I would say probably about a little over about 7-8 years old, which also kind of transposes into the AIF format. On the retail side, you have the full suite of products, and these are largely segmented based on the kind of end customer they are dealing with, or the kind of end use that is being financed, and or the ticket size which is being financed. And if you think about some of these products, they sort of have a hybrid impact. So for example, if you're funding the supply chain of, let's say, a corporate, then you're thinking about the risk profile of the corporate as well as the risk profile of the entities which are part of the supply chain, depending upon the nature of the structure, whether you're doing recourse or non-recourse financing, what's the comfort level, what's the data being used. Predominantly, the sector works on cash flow based financing, and collateral becomes more significant when it comes to auto loans or when it comes to, obviously, to gold finance. But otherwise, there's a large emphasis on thinking about cash flow based underwriting using data. And increasingly, the digital footprint of these customers and enterprises has increased, which is, helped a lot of the underwriting approaches at the NBFCs. When you think about the means by which the credit is acquired, and this becomes interesting in terms of the roles that it's throwing up now. A big development in the last few years has been the growth of partnership-based lending or co-lending, where NBFCs tie up with other NBFCs or banks tie up with NBFCs for origination of loans. In many cases, these are also fintech platforms, which is what we're referring to as credit fintechs, which are accessing the end customer and then passing on, in some sense, the opportunity to the lender, the NBFC or the bank, who then underwrites and decides whether to acquire the loan. Secondly, there has been a growth in portfolio acquisition or financing through securitization, DA, etc. And this has been a way for entities to basically diversify their portfolio and look at new segments of growth, achieve quicker inorganic growth in a sense, because there's track record information available on the portfolio at the point that they are underwriting. Thirdly, and very interestingly, we've seen the growth of ecosystem financing. And this is, I would say more common in the fintech ecosystem, where you either have embedded finance, which is issued at the point of acquisition of a product, or partnerships for financing an ecosystem, such as, for example, a procurement ecosystem for MSMEs. So these are some of the categories and types of credit that we see in the NBFC space. Now, what's changed and how does this relate to the opportunities for us? I think one is a significant increase in digitization. So NBFCs have very actively leveraged the India stack. We've also seen the rise of ecosystems such as ONDC, which provide opportunities to reach a lot of these end segments, and a lot of them have to be significantly tech-enabled. We've also seen the growth of fintech platforms which are reaching end customers, and therefore the rise of partnerships between the lenders and these platforms in accessing the end customer. And some of these numbers are quite staggering. A recent CRISIL report suggests that this market itself is close to about 1 trillion, and it's growing at a fairly fast rate. And I think, as most of us would know, there's a significant amount of regulation that has come into this market in terms of, aspects such as customer protection, fair practices, underwriting processes, disclosure of pricing, what kind of credit support or credit enhancement can be offered, and so on. And I think this has all made for, I would say, a healthy trajectory for growth for this ecosystem. Most of the credit fintechs also have a dual model. So they have a platform as well as an NBFC, which is kind of involved in the business. The platform, therefore, also works with third-party investors. We spoke earlier briefly about the mix of liabilities to say that bank financing is a large share of what the NBFCs are raising as liabilities. Clearly, the regulators, both the RBI and the SEBI, have been taking steps to see how to diversify the access to liabilities, not just for NBFCs, but also for corporates in general. But particularly, RBI is concerned about interconnectedness. And hence, there's a clear direction to NBFCs to raise more funding through capital markets. Particularly in the last few years, we've also seen the growth of platforms, which now need to be kind of licensed as OBPPs, which offer to retail investors bond investment opportunities, as well as in some cases structured debt offerings as well. Again, with the disciplined growth of these markets and with appropriate disclosure, this becomes an interesting opportunity for NBFCs to raise liabilities as well. And this changes the texture of fundraise that NBFCs will need to do, and also the opportunities for investment in the market quite significantly. And very interestingly, we've seen even lower rated entities. So typically the bond market tends to be, of course, very liquid for higher rated paper. But we've seen greater access both for public issuance of NCDs as well as secondary investment through these platforms for lower rated entities as well. I'm just going to map some of the guidelines that have changed the industry in the last few years to the kind of opportunities that are coming up now. I think the most significant was the implementation of Ind-AS for NBFCs, the alignment with IFRS, which basically means that today an NBFC needs to have an analytical approach to segmenting and valuing its portfolio, thinking about what are the means of fair valuation. And also, interestingly, there has to be an emphasis on building and maintaining internal models around credit provisioning. And this includes thinking about mapping the probability of default, loss given default, and using these inputs to also think about forecasting what the kind of portfolio performance is likely to be, and thinking about therefore also capital impact for these portfolios going ahead. And that's kind of changed the way people approach risk in some of these entities as well. Second, as I mentioned earlier, there's a focus on building internal models for capital assessment. So, for example, in a mid or large NBFC today, across the risk and the finance teams, there would need to be capabilities built to think about building models for holistic risk assessment across different pillars of risk, and to generate output. So you need to build the models, you need to implement them, you need to run them, backtest them, and you need to be able to generate output that can be shared with the regulator on a periodic basis, and hence needs to be fairly robust. While at an early stage of adoption, some of these initiatives depend obviously on support from consultants. What I've seen at least is that in steady state, a lot of these roles are handled in-house. I think also the creation of platforms which will then get licensed as OBPPs means that Treasury teams and NBFCs are now raising a larger portion of funding through bonds, structured in various ways and to meet different goals in terms of their liability management. Also, as part of certain liquidity guidelines, NBFCs have been required to maintain certain minimum liquidity, portion of which also means investment into, let's say, Treasury bills, for example, or government securities, which they need to also build models for internally. I'll quickly run through what I see as the career opportunities in different functions of NBFCs. We can then see if we have any more questions around that. At a very generic level, for a lending business, for example, a lot of these entities would have origination or a business team that kind of looks at how to acquire clients. In some cases, this would be direct. Some cases it would be partnership driven, or it could be driven around a distribution structure like a branch network. They would have a credit team which is involved more in terms of the basic underwriting process, and also responsible for running different models as well as monitoring the portfolio. The risk teams typically will formulate policy, will formulate models, and maintain them, and also report to the the internal and external stakeholders in terms of the existing and expected risk performance of the portfolio. Then there are a few functions which are sort of interlinked. So the Treasury basically manages fundraise as well as liquidity management and overall balance sheet management, particularly in terms of interest rate risks that the NBFC will needs to manage. Given that some of the products may be fixed rate products, especially when they are lending, and some of the lending may be long-term fixed rate, liabilities may be shorter term, in many cases variable rates, especially if they are linked to bank MCLRs, and so on. And the role of CFO or a financial controller will extend to thinking about how the models for provisioning being built, and are those adequate from the perspective of providing for expected losses and the segmentation of the portfolio and so on. And also the impact of different fair valuation techniques and the projection of the movement in fair value on the books on the net worth of the entity as well. So those become key questions. And there is a role to be played in terms of presenting the financial performance of the entity. So typically we see people with very strong financial skills who come into these roles, and strategy is obviously interlinked with also what we see as returns in different businesses, right? So understanding the competitive environment, understanding relative performance of different entities, thinking about the niche that the NBFC itself has, thinking about method for capital allocation based on returns profile of different businesses and other strategic objectives. And of course, the tech and the operations function. And, obviously, as is expected, the structure and the roles will evolve based on the life cycle of the organization, and will also differ based on the nature of the business. So, how much of the business is institutional versus retail, how much is digital versus digital, purely digital tech-enabled businesses. And the investment and competency building will therefore also depend on the split in each case. So very quickly running through roles which could be of interest for people pursuing or having a CFA qualification. When I look at how the origination function in many of these NBFCs is changing, I think apart from purely retail organizations, where there is not much of a variation in what they are originating, etc. But even at mid-levels and senior levels or in such entities, understanding the risk-reward trade-offs, thinking about product design, appropriate product pricing, understanding the profitability of different products and the businesses that they run are key to how the origination teams are basically managed, how they are assessed, and how they are rewarded in some sense. And I think this is very much in line with how the regulator is kind of thinking about prudent management of a lot of these balance sheets. And when we look at the kind of businesses which include, let's say, partnership-based origination, or it includes, a little more focus on institutional financing, deal structuring, transaction structuring, thinking about contract-related risks and how they translate into commercial risks for the business becomes very critical. And obviously, overall business planning, portfolio management skills. Because I think one thing which has changed, linking back to what we spoke about participation in capital markets products such as direct assignment and securitization, If an NBFC has the ability to sell down portfolio, then there are continuously decisions being made on what portfolio to hold, what portfolio to sell, and also what portfolio to originate on the basis of liquidity available in the market. And these are now becoming decisions which go beyond just originate to hold on the books, resulting in active management, and skills around that become very relevant. Also, I think a lot of emphasis on the right business analytics, dashboards, MIS, which then becomes useful for decision makers. And the roles in origination, I think, are expected to kind of think about it. And when you think about it, business analytics could also extend to operating cost structures, what's the optimal loading at, let's say, different origination channel levels, and so on. Some NBFCs also engage in syndication or distribution related activities for their clients. In fact, I would say many of them do it at different levels. So either on a partnership basis or on a deal by deal basis. And therefore, origination functions could also be in terms of interaction with other investors, co-lenders, investors, and so on. And a lot of these skills would extend to roles in those functions as well. We spoke briefly about credit and risk related functions. So I think the ability to understand constituents of the current portfolio, think about the risk characteristics of different segments, build that into an analytical model. Also factoring in macroeconomic variables. So for instance, the ECL models and the ICAP models also would require an understanding of the macro environment in which the NBFC is operating. So functions would, require skills in terms of thinking about the right variables, modeling them, combining, basic analytical and modeling skills as well. And also building feedback loops to see how these models are working. At a credit underwriting level, there's greater usage of scoring models. So today, most NBFCs have a significant amount of digital data capture, where they're getting information on the characteristics of their borrowers, not just the borrowers themselves, but also the industry or the area and they're operating. And they're using both macro and micro indicators to fine-tune their scoring models. They're able to access the bureau for other parameters as well. And here again, there's an opportunity to optimize both operating cost and credit cost based on better models which are being used. And it's also likely that a lot of this data will lend itself to the application of new AI and ML models. And some of this work is at a fairly early stage at this point in time. Also, when you think about risk management and when you think about the data available and the scope for liquidity in the market, then active portfolio risk management becomes interesting. So you're no longer thinking of a portfolio that's just originated and being held, but the ability to sort of proactively manage, let's say, sector concentration, geography concentration, counterparty concentration, and so on. And also, in a sense, dynamically think about originating assets that match different cost of funds tenors, and so on. So the ability to do some of that also becomes quite interesting. So I would say that the market is probably maturing closer to some of the developed markets today in terms of some of these approaches. The introduction of the ERM framework a few years back for NBFCs has meant that there's to be a very organized approach to documenting different risk factors, building the heat maps, doing the checks on a periodic basis and reporting back. And these have now become a regular feature for most of the NBFCs as well. The treasury and fundraise side, I think, offers the most interesting set of roles. Again, here, both in terms of fundraising. So today, for instance, thinking actively about capital markets, be it domestic, institutional, or, private wealth, HNI or retail fundraising through bond structures, as well as I think the whole focus on climate and sustainability has brought in a new range of products that, NBFCs can potentially raise. So for example, an NBFC could think about raising a green bond, a social bond, or a sustainability bond based on the end sectors in which they're able to deploy. And that comes with its own requirements of, criteria in terms of origination criteria, in terms of ongoing reporting. And this requires both financial and analytical skills to understand how to allocate the right origination to these bonds and the bond structures themselves, also engaging with the appropriate rating agencies. So some agencies also review and sign off on the kind of deployment that they've done and so on. So some of that also comes in. And of course, portfolio sell down. So structuring the transactions in the appropriate way to optimize capital relief and or the cost of financing that comes in. So that's some of the most sophisticated work that happens within the treasury teams of the NBFCs. On the other side, in terms of engagement with investors, the way the rating agency looks at it or the way the investor looks at it, thinking about the loss estimation on the portfolio and what's the optimal level of credit announcement that should be offered for a particular rating, for example, will result in more efficient management of capital by the NBFC. And these become important skills that the treasury teams of NBFCs build as well. We spoke earlier about liability management. And I think overall, the role of a CFO today in an NBFC has become far more sophisticated. Whereas earlier it was largely perhaps related to governance reporting, financial reporting, and capital management at a basic level. Today, I think there is a significant emphasis on fairly dynamic capital allocation, proactive management of capital requirements on the book. And there are multiple events that influence the capital availability. There are multiple factors that influence the reported profitability of the entity, especially given that Ind AS has moved the view of the book from static to more dynamic. And also there's a greater emphasis on more detailed reporting at a product business segment, or in some cases right down to the unit cost level, whether it's a branch or a customer and so on, and allowing for better operating leverage for the entity and also competitive scanning. And all of these then translate into specific skills that would be required for the operating team, which sort of manages some of these areas as a composite. I think the last piece is more around, how do you think about capital raise, communicating your performance analysis, and then stakeholder communication management. These are, typically standard for any investor relations kind of function. So it involves both an inward view in terms of understanding of performance, the ability to project performance to the extent required for internal stakeholders, as well as competitive analysis with relevant benchmarks, sharing the drivers, thinking about the value chain, and how the return ratios stack up and what's current, what's expected. So this is, I think, fairly standard and everyone understands this, but this is increasingly becoming relevant for NBFCs also because a lot of them are now in the listed domain. And this is part of, therefore, the internal commentary and also part of how you kind of think about communication to external stakeholders as well. This is a very brief summary of how we think about level-wise skills, competencies. And, while this is set up in a more generic way, I think it's true for roles in the NBFC space as well. So at an early stage, the skills tend to be more technical in nature. So responsibilities were typically around financial analysis, credit underwriting or assessment, financial structuring. When you think about particular products or transactions, contracts, and so on. And if you're working on the credit or the business side where, there's usage of models, policy, so the ability to follow that, ability to follow processes becomes important. And I think this is a stage at which, employees obviously build the domain knowledge and they start figuring out how to use it in different contexts as their role expands, as they move across different functions as well. And I think what has really stood out for me when I've looked at a lot of the folks who worked with me over the years is the people who are more curious, who come with a higher degree of ownership. They have an entrepreneurial mindset, and also think out of context. So, a lot of people are very good at doing what they are told to do. But the ones who take initiative and are able to kind of come up with solutions for problems that, others take for granted. And I think that makes a huge difference. And I cannot overemphasize the for we do overall. And obviously, as you progress to a mid-level, this is, more about, leading certain business segments, subsegments, or functions, particularly. And also there, the skills are more relevant around how do you think about resource allocation, planning, managing teams, or if you're in a, technical function, then designing the products and policies, etc. And obviously, managing people becomes a big part of what you need to do. And therefore, you leverage your domain knowledge, but you also learn how to collaborate with others and influence for key organizational goals. And lastly, at a senior level, it's all of this plus the ability to kind of do strong stakeholder management, both at the, let's say the board level, shareholder level, external level in terms of the lenders or the key investors in the company. And how do you think about building the right culture, driving, the mission and vision of the organization, and of course, representing the organization externally. And very importantly, I think particularly in the NBFC space, it's also been a lot about contributing towards the effort of self-regulatory organizations or driving industry advocacy. Since the sector has seen a lot of change over the last decade or so, especially certain subsegments like microfinance, for example, or the fintech ecosystem, and so on. And a lot of these are not yet matured. So it makes for very interesting roles across levels where, the learning curve tends to be quite steep. And you're also kind of building skills as a more, I would say, well-rounded individual across. And throughout, I think the one thing that's a very common and strong theme is the emphasis on technology and ability to kind of think digital business. And that's, become quite critical. How does one find opportunities? I think obviously at the entry level, there is a lot of recruitment that happens on campuses. I've seen positions advertised actively on LinkedIn as well. And if you research companies and approach the relevant existing employees for referrals, I think, that's a great channel. I've had a lot of people who approach me on LinkedIn, for such opportunities. At the mid-level, I think there are recruitment firms which are typically given the mandate to hire apart from all the other channels. And I think at a mid-level, it really helps to attend industry networking events. So if it's one thing the NBFC sector does well, it's the number of events that happen. So you will see tech, forums, there'll be investing forums, there are AIF forums, and then there are the general industry forums. There's a securitization seminar that happens every year. And these are great places to meet some of the people who are working in the industry across. And we'll speak a little bit about the ecosystem as well. So you get a sense of what the roles look like, which are good organizations to work with, who are the good people to work with. And that adds to your base of research. And of course, you can then leverage referrals. And at the senior most level, it's typically obviously headhunting, either by the company itself or by recruitment firms and your own personal networking. So if you feel that, you're at a level where you can really provide senior leadership for an NBFC. So to give you an example, there are people who've played, let's say, mid-level roles at banks who would be able to play a leadership role at a smaller NBFC. And that's a great opportunity to see an organization through scale up. As well. And obviously, if there's an investor network, then that can be leveraged where you reach out to the investor and express your interest. And then they could refer you to the company as well. I've also seen the CFA Society engaging in initiatives where they are reaching out to corporates to come and present to the, the ecosystem of candidates and charter holders. And I think that's a great way to find these roles as well. Lastly, I think when you think of opportunities in the sector, don't take a siloed view of just thinking about NBFCs and fintechs. I think some bit of a stint or an experience in the sector for a few years means that you are more than ready to then work with a lot of others in the ecosystem who have a focus on this sector. And just given the amount of capital that the sector needs to raise. I think it's over a few trillion rupees over the next few years. You can take it as given that a lot of these external parties are going to be deeply involved with the ecosystem. So a stint with the NBFC space could make you ready to work with investors who may be, banks, mutual funds, AIFs, others who are fixed income investors into the space. Let's say wealth firms who structure and offer products, and understanding of the space could be very, very valuable. We've also seen an increase in the participation by impact investors, especially offshore lenders, DFIs, multilaterals who are coming into the country and running programs. Every other day, you'll see an announcement of a large transaction where they've invested in one of the domestic platforms. And they're always looking for good local talent who can work with them. And there's a large ecosystem of investment banks, merchant banks, both for debt and equity, which supports the industry. Simply because capital is the raw material for NBFCs, be it debt or equity. And hence, there is a very high recurrence of transactions. The transaction momentum and activity is high, and therefore there's an opportunity to engage with the ecosystem. Rating agencies work across, obviously, both issuer rating as well as transaction rating for securitization deals, for example, or bond transactions and so on. And that's a great opportunity. And research consulting remains big. There's also a large base of equity investors that fund these entities at different stages, and especially the fintech ecosystem has attracted a lot of these investors. Be it VC investors who work with early stage companies or mainstream PE investors who are working with mature platforms, or even, PE investors with an impact strategy who are working with some of these companies as well. So that's, I think, where I largely conclude the session. And, we could kind of see if we have any questions that we'd like to take up at this stage. So back to you, Litesh.
Thank you, Bama, for sharing your insights with us today. As a reminder to our listeners, please do complete the evaluation survey as appeared on your screen at the end of the session. CFA Institute and society members can claim their PL credit by logging into their online PL tracking tool. So, Bama, here, in terms of you have shared your views on the NBFC sector and given some broad idea on the banking side. And since you have worked on both the sides, that is banks as well as NBFC, in a way, you are the right person who can kind of, in a way, give both in the sense the overlapping opportunities and situations versus the things which are different and unique in terms of both banks and NBFCs and why they would be interesting in their own way.
No, absolutely happy to do that, Litesh. So the way I've kind of looked at it would be one, let's say the depth, which means the technical content or, what do you do in your role? And second might be the width or the span in terms of how much impact or influence you can have in your job, right? My sense is in roles and banks, just given the size of the organization and the size of teams and the scale of operations, the latter tends to be more narrow. So let's say that, there's a fairly complex activity in terms of, let's say, building a model or designing a portfolio strategy for a particular segment of the business. A person might play a part in that whole activity, but they may not have extensive, I would say, impact or influence around the overall agenda. They may also have lesser visibility on the big picture. So they may not understand the why, and what exactly is being done, what is the strategy, what is the thinking. But the technical skills, I think, may be very rich. And also given that, a bank would typically have a lot of data available with it. The ability to kind of, use a lot of that data, come up with interesting models, etc., may be significantly higher. For NBFCs, I feel that, the latter would be better because, they tend to be smaller organizations. And today, even an NBFC of at least 1,000 crore, which is in the mid-layer, has to do a lot of things that, are closer to what bank regulation looks like, right? And therefore, a lot of those require financial analysis or portfolio analysis skills, which as an investment professional you would need to have, and you would also understand the context or the big picture better. So you would be part of a core team of people, and typically, what I've seen is that these teams may be fairly small, 2 or 3 people who are working on it, and hence they have better learning opportunities and growth opportunities as part of that ecosystem. Whereas the ability to kind of use data, etc., may be more constrained because of the nature of the industry or the role, because it is a newer organization, smaller organization. So you're working with lesser visibility, but you can have greater impact and so on. I just feel that probably at mid-career, this is a good shift because, you get a good sense of a new sector and a space. And then you can sort of decide if you want to grow in that role or you want to move to, a different part of this ecosystem as well, or potentially become an entrepreneur like you, right? So there are different avenues which are available if you build your skill sets in this space. That's my sense. From a regulation and compliance perspective, frankly, today, I think the right way to think about it is if you're doing an activity which a bank does, you better do it, in the same way in terms of regulation and compliance. And there are, the regulator doesn't appreciate any arbitrage or loopholes there at all.
Yeah. So like in last maybe 1.5 to 2 decades, what I have observed is that a lot of banks have also come up in the sense the small finance banks and payment banks, those kind of newer licenses which were given by RBI. Plus, there are a lot of new NBFCs which have come, and in a way, if we see the weightage of the sector in the indices, at time it was close to 25%. Now it is close to say 15 to 18%, but still it is a heavyweight sector, and we have a large Nifty bank which is on a daily. If we see the volumes, it is traded very heavily on a daily basis. So one thing that I have observed from these things is banking is more regulated, so it does not give you more elbow room to do structuring, but you can play with the pricing because you get the borrowings, means the funds at a cheaper rate, versus NBFC is even the RBI wants some sort of a structuring or whatever to happen at the NBFC level rather than the bank level where there is more retail participation.
You're
So
absolutely right.
yeah, continue. Yeah.
So I would agree with you that probably in case of banks, they play more in terms of their competitive advantage, which is their access, reach, lower cost of funds, ability to handle, significant volume of transactions. Digital view is much better. So if you have an account with the bank knows what's happening in terms of cash flows in and out. Versus an NBFC is trying to play more in terms of the strengths around agility, maybe better understanding of the customer because they focus on certain segments as opposed to a bank which needs to diversify and provide access to a larger customer base. And maybe more agile use of technology. If they're able to develop and roll out technology faster and improve the user experience, therefore. And very importantly, as you mentioned, therefore, the ability to tailor products to a customer. So for example, I know NBFCs who are able to kind of think about designing and offering products which are very short-term in nature and predict the kind of cash flow turnaround that happens there, which would be harder perhaps for a bank to do. Given that they would also have to deal with where all they would offer this product, who can access the products and so on, right? So I would say it's probably deeper understanding and agility on certain areas versus clearly the ability of a bank to leverage its size, scale, balance sheet strength, and so on. And hence, I think it makes for a great partnership. And which is actually why, if you see, the co-lending market has taken off significantly.
Yeah. In fact, in your earlier presentation discussion, you had mentioned about cash flow based lending. And one classic case that I can kind of correlate and connect is the lending to the real estate sector, now that I'm very active in this part. So if we see the home loan segment, which is the vanilla segment, where it is hyper competitive, there are banks, both private and PSUs, fighting for the new customer. versus in case of the developer, the construction finance, primarily it is the NBFCs who are taking a higher risk, but they are getting a higher yield, getting anywhere from so for home loan it will be 8.5 to 9%, versus for say construction finance it will be anywhere from 13.5 to say 16%, and plus over and above that there will be AIFs who will be charging say 18 plus. So these are kind of models which have come up, and you might be having more examples similar nature where NBFCs are in a way looking at the same sector but giving a different product.
No, absolutely. Absolutely right. So for example, I think if you think about it in the context of MSME or supply chain financing, right, which is a classic parallel like what you're describing. So if you look at the target segment for banks, they would typically do financing which has recourse on the balance sheet of the corporate, in case of their vendors, or they would work with a tier one retail chain, right, where they know that a stop supply makes a huge impact on the entity, and therefore they rely on such contracts and the prior experience to actually fund them. And in many cases, the tier one by themselves will be extremely creditworthy entities. Whereas if you go down the tier of the supply chain, there are smaller entities, in the supply chain, whether it is, vendors or dealers, where the access to credit is much poorer. And the bank, based on the kind of ticket size that they need, or the size of that entity and so on, may not actually find it very attractive to go and underwrite that customer or offer them credit, right? And the risk reward ratio, especially when you consider operating costs, may not be interesting for them. But for an NBFC, that becomes an interesting target segment, because they are then able to go in and underwrite a customer segment that, the bank is not approaching. They're able to use their low-cost networks in some sense to reach these customers, deploy tech to access the customer, and bridge some of this gap, and therefore, charge a little bit of a premium for the effort that they are putting in and the availability of funds. Because in many cases, they're also basically substituting informal borrowings or much higher rate personal loans that would otherwise be the source of funding for these entities. So that's a interesting example of a partnership that kind of operates. In some cases, for example, the supply chain of a mid-market company may not really be a great banking segment at all, right? So you may see NBFCs coming into that more and being able to, cater to their requirements. And a lot of NBFCs which have kind of come into that business model. Or even if you think about the housing loan system segment, for example, it's more affordable housing loans, and then the prime customers go to the others. And as the customer builds a credit track record, they naturally, kind of graduate out of the NBFC or the small HFC ecosystem and move to the, let's say, larger HFCs or the banks, right? And that's another, I would say, good example. So I would say that there's a lot of coexistence, and which is actually why when, taking a step back, when investors look at these NBFCs, I think one of the key questions they try to answer is what is their competitive advantage? What are the key markets that they are playing in, and why will that competitive advantage really last, right? So if they're trying to do what banks are doing, and they're trying to kind of compete with higher cost of funds, and so on, and depending actually on the banks to fund their liabilities. So then that's a very short-term game, right? And therefore, thinking about what is differentiated or innovative about the approach, and what is the pain point they're trying to solve, and why will the business model therefore last, whether it's the fintech or the NBFC ecosystem, becomes a very interesting question.
In fact, as you mentioned about the competitive advantage, I can remember or recollect few names in the NBFC space where they created their own niche, and they have now become equivalent or even bigger than some of the banks. Bajaj Finance,
Absolutely.
immediately you come to know personal loans.
Yeah.
Then Mahindra vehicle financing, Shriram vehicle, Muthoot gold. So in a way, they created their own niche, and they are now kind of bigger than a lot of smaller mid-tier banks.
Yeah, absolutely. And I think that's where the fintech innovation has been very interesting, because the way the fintechs have changed the landscape is by making the user experience a lot less painful, making access smoother for them. So today, a customer of a fintech can complete, let's say, their KYC online. They can provide information and get a sanction online. and are able to kind of draw down the credit, repay, and their experience is relatively painless. And therefore, the customer prefers to stay on the fintech ecosystem. And the partnership mode basically allows them to then access cheaper funding through partners who come through the fintech ecosystem. And that becomes a win-win for, honestly, for both the players as well.
Yeah. And like in the sense when we are talking about these new age NBFCs and where there is a kind of a thin line between startups, fintechs who are operating in the NBFC space, where does the whole wealth management come into picture, and kind of any big names that you think of are kind of operating in this segment and doing it pretty well?
Yeah. So I think there are two or three approaches that we've seen on the wealth side for these customers. So I think one is where you have platforms that are anyway offering other products and are also offering fixed income products. Like, for example, let's say someone like a Golden Pie, right, or an India Bonds, and many others who are also, they've always been doing something in terms of offering investment solutions for clients. And today there's a broader offering in terms of a wider range of fixed income products, also including NBFC credit and so on. And those are, I would say, probably the broader platforms. And then there are more narrow plays where people have identified themselves as specialized players in the alternative credit or the fixed income ecosystem, which is largely today dominated by NBFC issuers. And this includes either balance sheet bonds of NBFCs, which could be, for example, in some cases, they are bonds issued by, say, gold financing entities with specific liquid portfolios which are tagged to them. Or they could be securitized debt instruments which are being offered, and so on. Or in some cases, they are in fact asset financing. So for instance, let's say supply chain receivables which are being securitized and the paper that's, for the underlying is that. And so on. So some of these are coming onto specific platforms, which are, then being offered to customers. But I think the basic tenet remains the same, that if you want to be a wealth advisor or a manager for a client, then you need to approach it as a more diversified play. So you can't be a niche operator. So you can either be a product provider who says, this is my niche and this is what, I know well, and I will be a sub-advisor or a platform that offers these investment opportunities. But if you expect to be an advisor to, to an investor, whether it's a retail or high net worth investor, then you better have a wider approach and a view. And obviously, if you're an advisor to them, then you have to deal with not being conflicted in terms of distributing products, right? So those basic tenets, I think, remain. But the interesting development is the expansion of these online platforms where you can access a lot of these fixed income products. So which, let's say, any retail investor, any of us can go onto some of these platforms and have a program around investing small tickets to add to the portfolio diversification that we have and learn this as a class much better. And I think that's kind of, in a sense, tokenized the fixed income market significantly. And that's something I think the regulators also supporting with adequate safeguards in terms of licensing and regulation to say, then there's more liquidity in the bond markets, and there's also possibly more access for a wider set of issuers. And I think that's the interesting development of the last few years.
Right. And Bama, you have kind of, in a way, through your presentation, given some broad idea in terms of the career opportunities and what people can look at. Now, in terms of if somebody is a fresher and when he or she is looking at the whole banking and NBFC space, then any specific area or job role that one can kind of start with, and then what things they should do to maneuver around and kind of grow in the whole system?
Yeah. So I think entry roles, a good place, I think, would be probably risk or credit policy kind of roles, where you are able to kind of use your analytical skills apart from just the, the basic credit and portfolio skills. So you get a view at least of how these models are being built and what's happening. So I think that's a great start. Also, if there are entities which are doing more some amount of institutional credit, right? So where they are lending to other financial institutions or investing in their paper, that could be a good place to enter the ecosystem. Or what I mentioned, which is some of the platforms, investment banks, merchant banks who are working in this space, which is adjunct to the NBFC space. So it's not a job in an NBFC, but it's adjunct to the NBFC space, right? So those are all, I think, good places to kind of start for many of these freshers. We've had a lot of freshers who join us and then go through their CFA journey while working, with Northern Arc, for example. And we've always actively encouraged that as well. And you will find that employers are happy to support that journey. I think you're on mute, Litesh, sorry.
Thanks, Bama, for once again, thanks for sharing your insights. We are kind of completely out of time. That was an insightful session, and in a way, a lot of things to discuss, to understand, but we have limited time for now. Maybe sometime again, we might have a similar session with more detailed analysis from your side.